Scholes option pricing model, or VSOPM. Here in this Scholes option pricing model, what you have to remember is this is basically a model which is used in computing the theoretical price of an option as an investment option, no, avenue. So in Scholes model, we will be looking at computing the theoretical price of an option as an instrument. It includes both put option as well as call option. So that's a basic idea behind going with Scholes option pricing model. Now let's look at how this is going to be. So this is the background about this model. As indicated by the name itself, this has been introduced by Fisher, Black and Myron Scholes. They have gone with a lot of theories in investment management. One of their well-accepted theories is Scholes model. It was first proposed in the year 1973. And as I said at the beginning, it is for determining the theoretical price of European style option. Okay. Initially, when they brought in, it was related with computation of stocks which do not have any dividend payment during the holding period. So the basic assumption is dividend is not received as an income during the holding period. But there is an alteration, there is a revision of this model which can also incorporate dividend income in your computation, that we will be discussing towards the end of our today's class. Okay, so first we will go with the discussion regarding an option. Underlying asset definitely is a stock, and in this the assumption is it's a non-dividend paying stock during the holding period. So that's a primary assumption when we go with the initial discussions about Scholes model. Okay. Now, as we have learned, this is something which is very common to all the models, to all our discussions regarding option prices. But we are just bringing that back again to continue with our discussion. Factors that are affecting the option prices includes current stock price, that is the market price that is prevailing with respect to the underlying asset, the strike price or the exercise price, which is nothing but the option price, which is determined based on the stock price as well as the time involved in holding this instrument. Also, the risk is automatically incorporated into that. Then the third thing is time to expiration of an option contract. It can be 1 month or 2 months or 3 months. Depending on that, option prices also will vary. Volatility of the stock price. Generally, in option computation, volatility of stock prices are denoted by standard deviation. Then risk-free interest rate, even though we know that there is no such concept of risk-free interest rate, but those assets which are having which are giving a return near to 0% risk, like as we often got it as bank deposits. So risk-free interest rate, which again which is another part of our computation, which can be regarded as a opportunity cost also, right? Opportunity cost, which is considered to be the minimum return which we can expect if we did not go for this risky option. So that's why we call that as a opportunity cost. Okay. That both, it's for investing and borrowing, we assume that to be the same rate, and then we go with the basic assumption. So these basic assumptions, as I always say, sometimes it may not appear to be very realistic in the real market condition, but in order to simplify our calculations, we go with some assumptions to proceed with the model. Okay, that's why we go with this assumption. And in this case, the first one is there is a continuous market. Stock trading happens in, which is true, there is a continuous market when you have a secondary market called stock exchange. So that is one assumption. So that what happens here is, what is the implication of this is, price of the asset is decided based on demand and supply, based on market forces. Automatically, that will be incorporated into the price of the underlying asset. So that's the concept which we want to understand in this particular case. Then no transaction costs, literally that's not possible, but just to know, because if we are trying to compute transaction cost, it will vary from country to country, it will vary from asset category to category, it may vary between different periods, it may even vary between different organizations. So just to avoid all those confusions, we keep transaction cost as 0. Okay, no dividend on the stock, which I already said, but we are also learning computation if dividend is declared based on the underlying asset. That is very simple, not much computation, just one factor incorporated into the stock price. That's nothing but present value of the dividend. That's what we are going to discuss at the later stage. But for the time being, in Black-Scholes model, the primary Black-Scholes model, the assumption is there is no dividend declared during the holding period for the underlying stock. Then the next is same tax rate to all trading patterns. All trading patterns means it can be investment, it can be speculation, it can be long term, it can be short term, right? So, but in real scenario, this may not be correct. But just to simplify, we keep that there is same tax rate applicable to all types of trading patterns that are prevailing in the market with respect to European call or put. Then borrowing and lending at risk-free interest rate is possible. May be true in general condition when you do not have a liquidity crunch, borrowing and lending at risk-free interest rate is possible. No riskless arbitrage opportunities, that's also true, because if you are trying to invest in a stock market, there is an element called risk. So there is no riskless arbitrage opportunities. As you know, it is actually we are trying to gain out of the price fluctuations with respect to same asset in two different markets. That's what we basically try to gain through arbitrage opportunities. And it's risky because you cannot always predict the market movement. So it's risky. That's why no riskless transactions. Then stock prices follow a random walk, which we have learned what is random walk. That is, there is as you cannot predict the future movement based on the past movement. It happens at random. There is no relationship which can be projected based on the past movement of the stock prices. So at random, the price movement happen at random. It come to arrive at different prices with respect to underlying assets. So nobody can really predict what is going to be the next. There is no historical analysis to go with the prediction of future prices. That's what we say. Price movement happens at random. It is not related to the past movements. Certain cases it is correct, but random theory is not always applicable in a real-time stock market conditions. Then there is no applicability of technical analysis. The basic idea behind technical analysis we have learned is predicting the share price, future share price from the past moments. Emphasizing that the future prices incorporate the happenings in the market, and the price of a security incorporate all the happenings in the market with respect to industry, company, and also the other external environmental factors. And one can to some extent predict future prices based on the past moment. So that's the basic idea behind technical analysis. But random walk theories when go with the concept of saying that there is no relationship between past and present or future price movement. So that is what the basic assumption in Black-Scholes pricing model also, option pricing model also. So stock prices happen at random. These are some of the assumptions which is being made in Black-Scholes option pricing model to proceed with the computation of theoretical option price. It's very simple. Maybe when you consider that's why we learned the difficult one at the beginning. It's very simple with respect to when you compare with the binomial pricing model. Just you have to remember a formula, and the application of that is something which will help you to arrive at the put option or call option price, option premium. Okay. Now, the formula. I said the formula is very, it may look little complicated, but basically it is very simple. Here, the C is what we call as the European call premium. Premium is the price for you to, the price you have, which you have to pay for buying one call option, one call in the sense, if you are going with purchase of a particular call that is offered in the market, there you can see also what is the premium per call, right? So that is what we call here as European call. Now you know the basic nature of European option. Here your exit out of the market is expected only during the expiration. Okay. Now, we are going to discuss the theoretical aspects, what happens if it is an American option, but practically you really have to solve the exercise which is connected with European call option, what call and put option. So first we are going to discuss the formula of call premium, how to go with computation of call premium. And as you know, this is spot price, right? And we are going with, as I have given, D1. D1 computation is with respect to natural logarithm of spot price by K, which we know, the strike price, plus R, risk-free rate of interest. This is standard deviation square, volatility square by 2, and T is the time period of holding the asset, maybe 1 month, maybe 6 months, that's it. And the standard deviation whole root of T. This is D1, which we have put here, D1, right? And D2 is nothing but D1 minus standard deviation of whole root of T, which we have used here. And E raised to negative RT, this we are already familiar with for finding out the present value, where E is the constant, which is having a value of 2.71828. And we know that we have to find out the value by using a logarithm table. We have to find out the value in the anti-logarithm table, where E is the base and R is the risk-free rate and T is the time. And same as the case, P is for European put premium. Okay, again, all other variables remain same. What you have to remember is there is slight variation in the formula depending upon the concept. Because in call option, we say that if a person has to exercise it, the strike price should be less than the spot price. But in option, it is input option, it is just the reverse, where your strike price should be more than the prevailing spot price. Right? That's where when you go to exercise the put option. And here this is calculation of European put premium. We are actually moving further, where the steps are, we will go with finding out the value for D1 and D2, and then we find out N of D1 and N of D2 using the statistical table, which we are going to do it. Practically, we are going to try it out, work it out. So you will be knowing better. Like, when you hear it from me, the theoretical part, you might find it little difficult, but once you do it, it's very simple. And calculate the price of the option by substituting C and P in the formula. Okay, I'm not reached the next one. I'm just showing you this part. So here, when you substitute the values, you will get, in case of C, you will get the premium which you have to pay for one call, and P, which will give you the premium which you have to pay for one put. European put and European call. That's very important, because in American option, the concept is little different, where you have exit option at your preference. Suppose if you find that you want to exit before the maturity, it's possible, that we have learned, right? So C and P is something which we will be finding out using this formula. Okay. Now, These are the steps. We will go with finding out D1 and D2, finding out the table value uh, from our log natural log, and then we go with computation of once we get the value, we substitute it to find out the value of C and P. That's what the steps involved in it. This is the theoretical concept. So to summarize, what I would be suggesting is as we say, the Black-Scholes option pricing model is basically looking at finding out the theoretical price of option under European call and put option, where we will be looking into computing the option premium amount which we have to pay when we are planning to buy one by comparing with the current prevailing price. And as we said, here in this model, we would not be considering a case where you receive the dividend during the process. That is, our assumption is there is no receipt of dividend during the holding period of this underlying asset, that is stock. Stock, definitely, there are possibilities where you can get dividend. If a company is into habit of declaring dividend like interim dividend or maybe annual dividend, you might be receiving it, but the assumption here is you are not receiving a dividend because that can reduce your price obligation. How much you have spent for procurement of an asset. Suppose you get a dividend, the total price you have spent for a procurement of an asset would be different than a case where you don't receive a dividend. When you receive a dividend, the total amount, total investment may be little less because you get a dividend as a return. So you will be reducing that from your total price for procurement of your asset. So that's the difference which you will be there. But in the basic Black-Scholes model, you are not considering the chance to receive a dividend during the holding of that asset. That's something which you have to remember, because we are learning what if you receive a dividend afterwards. So this is the summary, and as I said, it is a model which is being proposed by Fisher and Myron Scholes. Okay. Now, this is a case. Okay. You have to remember this case. This is a case where the same thing, you're going to arrive at P and C. You're going to compute the call premium or put premium in an European option itself. But you are going to use a little simple formula, okay, with not much calculation, only where there is a case called put call parity. If I'm going to explain what is put call parity. Suppose if there is a parity is equilibrium, equal. So you can guess what it should be. It is equilibrium or equal. So if there is a situation called put call parity, in that case, you will be going with using this formula instead of the previous one which we discussed. Okay, now what is put call parity is, here when a European call and put option have the same strike price with same expiry date and with the same underlying asset, that condition is what we call as put call parity. Same strike price, okay, same maturity, same underlying asset, that situation is what we call as put call parity. So there are many things which would be common for them, right? That's why the formula for computation would be like this: P is equal. Then once you know the value of P, it is easy for us to find out C also. P is equal, the basic formula is C minus P is equal to, it would be strike price. We know that, right? Strike price minus, spot price minus strike price, the present value of the strike price. K into e raised to negative RT is nothing but we are finding out what is the present value of that income which you are getting after 3 months or 4 months or 5 months now. That's why you are making a comparison. Spot price is now, 0th period. You are looking at what will be the return you are going to get after some time. maybe after, depending on, suppose if the period is 3 months, after 3 months, what is the present value as of now? So the formula would be like that, which is strike price, spot price minus the present value of strike price. P is, it would be no, C minus the difference between that. That's very simple. Once you know the value of C, automatically you can compute the value of P. Same as if you know the value of P, you can compute the value of C also. So here what we try to find out is what is the call premium or put premium with respect to an European auction. The formula is very simple. When you consider with the previous one, you do not have that lengthy calculations of Black-Scholes model when you have a situation called put call parity. Put call parity is a situation where your strike price, your expiry date, your underlying asset remain same for both put and call. If that is the condition, you just have to go with application of this formula. So that's something which we have to remember when we go with the calculation. It's not that you don't get an answer for the previous. If you go with the previous one, we will get an answer, but to reduce the complexity in our computation, we can go with this formula. Right. So these two are the first category which we have learned for our today's class. First, we discussed about how do we compute the theoretical price using a Black-Scholes model, right, for an option, both put and call. Then we learned the condition of computation of option price in case of put call parity, right? And then the third one which we would be looking at in our class is calculation of option price when a dividend is anticipated. Because in our first one, we assume that the declaration of dividend is not happening during the holding period, during till the date of expiry. That's what we learned in the first. Now, what if you receive the dividend during the holding period? For that, we are trying to learn nothing more. We are just trying to find out what is the present value of this dividend return, and we reduce that from the spot price. I'm spending 100, but I'm getting 10 rupees as my, I'm not taking the present value, okay? Maybe if I spend 100 rupees and on that day itself, if I receive 10 rupee as my dividend, the total amount I had spent for buying that particular stock would be 90, right? Because I had spent 100, but I really received dividend of 10 rupee. So that's the concept which we are going with when we are looking at dividends being anticipated during the holding period. So here the problem with respect to this dividend earning is we are getting that dividend maybe after 3 months or maybe within a period of 3 months. So we are looking at the present value of dividend. So that's why DE raised to negative R into T, where R is the risk-free interest rate. We know that T is time to receipt of dividend, maybe 1 month, 2 months, or 3 months, or if it is 6 months, we will take that. And spot price of the underlying asset must be adjusted by deducting the present value of the dividend. That's the only change which you have to adjust when you are going with a dividend anticipation during the holding period of this particular stock. Right? Things are very simple. You just have to remember all these three aspects. So that's where we go with the concept when a dividend is anticipated. So remember, we had been discussing what is Black-Scholes option pricing model, Black-Scholes option pricing model, where we made certain assumptions. In that assumptions, one such assumption was that there is no dividend declaration during the holding period of this particular asset. Right, that was the first thing. And we learned a formula where we did not include the component called dividend. Right. But now we are looking it into a scenario. We are modifying the everything remains. The rest all remains same. We are just modifying that formula by adjusting the computation of S now. That's spot price on the maybe at the beginning of the period. Spot price at the beginning of the period would be adjusted by deducting present value of dividend which you got during the period. That's it. The rest all remains same. That's here. In this formula, you will go with this figure. While taking this figure, what you do is you will go with adjusting it. You will go with adjusting the spot price before you go with computation of F naught, which should be included in your formula by reducing the present value of dividend. So that's something which we have learned as an addition to the previous one, just to incorporate the concept called dividend declared during the holding period of the asset. So we learned those three things. That's it. We'll just have a recap of what we had been doing in our class today. First, we started with discussion of Black-Scholes option pricing model. We know that these models were proposed by Fisher, Black, and Scholes, and they proposed this model for finding out the theoretical price of option under the category European option, both for both put option and call option. And we also discussed some of the assumptions which are made with respect to this model, like the tax remains to be same irrespective of the asset pattern, stock movements are at random. Then we also discussed about the risk-free interest rate that is available for investments in the regular market. And another important assumptions which we made where there is no dividend that is declared during the holding period of the stock. All these things are made to simplify the computation. And we also learned that there is no transaction cost, which you might find it not related to a real market condition, but just to make things simple for us, we have assumed that. And another thing is stock prices are decided on a continuous basis. So there is regular trading that is happening in the market. We have a secondary market, so that remains more or less true with our investment option called options. So these were the assumptions. And then we looked into the Black-Scholes model by computing the value for D1 and D2, and then looking for those values in the natural logarithm, and then arriving at C or P as the case from the data by substituting the data in the formula. That's what the first part which we discussed. Now the same, of course, there also we know that the factors that affected our formula were spot price, the price of the prevailing price of the asset, the present value of the strike price, or as we call exercise price, both in case of put as well as call option. And another factor which affected is T, the time period involved in that, and of course the rate, risk-free rate of these were the factors which we substituted in the formula to arrive at, as you say, the price, the call premium price for call or put. And here we considered the anti-logarithm with E constant to arrive at, to find out the value for the figure. And another thing which we have to understand here, that is a case where there is no declaration of dividend. Now we learned a simple formula for computation of option premium, both for put and call with respect to European option, which can be applied when the condition is put call parity. Now the condition of put call parity is where you have option, both put and call option with same strike price, with same maturity date or date of expiration, and same underlying asset, in this case stock. In that case, we can go with put call parity, which is a simplified version of Black-Scholes option pricing model. These were the first two parts which we learned in our today's class theoretically. Tomorrow we are going to solve that practically. And then the last part of it which we learned is in Black-Scholes, in the primary Black-Scholes model, one of the limitation was we will not be able to incorporate such stocks which were receiving a dividend during the holding period. We could not incorporate that, but that is really a benefit for the investor when he is receiving a dividend in the course of his investment. So in order to incorporate the dividend element, Black-Scholes model was slightly modified by reducing the present value of dividend gain from the spot price. That's the only change which was made for that formula for incorporating the scenario of receipt of dividend during the holding period. So these were the three aspects which we discussed in our today's class.